It is found in understanding how money actually flows, and right now the flow is reversing. Welcome to the flow of money, a place where we do not tell you what to feel. We show you how the system works. My name is Arif, and what we are about to walk through is not speculation. It is documentation of a pattern that has played out in every asset bubble in recorded history. Bitcoin is not special. It is not exempt. It is subject to the same forces that govern all markets: liquidity, sentiment, leverage, and most importantly, the question of who is left to buy. Over the next several minutes, we will examine why Bitcoin fell this weekend. More importantly, we will examine why it is likely to fall much further. We will look at the mathematics of liquidation cascades. We will analyze the behavior of institutional holders. We will connect Bitcoin's collapse to broader market stress that most retail investors are not even aware of. And we will answer the question that matters: what should a rational person do when the mathematics no longer support the price? Let us start with what happened. Friday, January 31st, Bitcoin was trading above $83,000. Sentiment was cautious but not panicked. Then the weekend arrived, and in crypto, weekends are dangerous. Traditional markets close, stock exchanges go dark, but Bitcoin never sleeps. It trades 24 hours a day, 7 days a week, and when bad things happen, they happen when the fewest people are watching. By Sunday night, Bitcoin had fallen to $73,844, a $10,000 drop in roughly 48 hours. For those keeping score, that is a 12% collapse. If the stock market fell 12% in 2 days, it would trigger circuit breakers, trading would halt, regulators would intervene. But in crypto, there are no circuit breakers. There is only the price and the people trying to exit before everyone else does. This drop was not isolated, it was synchronized. Gold crashed at the same time, silver crashed at the same time. Analysts used words like ferocious rally, halted, and painful drop. What was happening was not specific to Bitcoin. It was a broader unwind of speculative positions across all risk assets. But Bitcoin, being the most volatile, fell the hardest. Now let us put this into context. In October, Bitcoin reached an all-time high of $126,000. That peak came on the back of two narratives. First, the belief that institutional adoption was accelerating. Spot ETFs had been approved. Major financial institutions were offering Bitcoin exposure to clients. The story was that Bitcoin had matured, that it was no longer a speculative toy but a legitimate asset class. The second narrative was the election. The belief that the Trump administration would be crypto-friendly, deregulation, favorable tax treatment, perhaps even a strategic Bitcoin reserve at the federal level. These narratives drove buying, not just from retail investors, but from hedge funds, family offices, even some sovereign wealth entities. The problem with narratives is that they only work as long as the price keeps rising. The moment the price stops rising, the narrative reverses. And that is exactly what has happened. From 126,000 in October to 73,000 today. That is a 42% decline, not over years, over 4 months. If you bought at the peak, you have lost nearly half your capital. And the people who bought at the peak were not just retail gamblers. They were institutions who believed the narrative. Those institutions are now underwater, and underwater institutions do not hold and hope. They liquidate. Here is how liquidation cascades work. Bitcoin trading is heavily leveraged. Traders do not just buy Bitcoin with cash. They borrow money to buy more Bitcoin. This is called margin trading. And margin trading works beautifully when the price goes up. If you buy one Bitcoin at $80,000 using 50% leverage, you have effectively controlled one Bitcoin with only $40,000 of your own money. If Bitcoin goes to $90,000, you have made $10,000 on a $40,000 investment, a 25% return. But leverage cuts both ways. If Bitcoin drops to $70,000, you have lost $10,000 on a $40,000 investment, a 25% loss. And here is the critical part. When the value of your position falls below a certain threshold, the exchange issues a margin call. They demand you deposit more cash immediately to cover the loss. If you cannot deposit more cash, they liquidate your position automatically. They sell your Bitcoin at whatever price the market offers, and when thousands of leveraged positions get liquidated at the same time, the selling pressure drives the price down further, which triggers more margin calls, which creates more forced selling. This is called the liquidation cascade, and it is exactly what happened over the weekend. Data from major exchanges shows that over $600 million in leveraged Bitcoin positions were liquidated in a 24-hour period. 600 million. That is not people choosing to sell. That is the system forcing them to sell. And forced selling does not care about fundamentals. It does not care about long-term value. It cares only about closing the position before the loss gets worse. This kind of selling creates what traders call a long squeeze. Everyone who was betting on Bitcoin going up is now being forced to exit. And because everyone is exiting at the same time, there are no buyers. The price falls into a void. This is mechanical. This is mathematical, and this is not over, because the 600 million liquidated over the weekend represents only the positions that were leveraged at the highest ratios. There are billions more in positions that are still open but getting closer to liquidation thresholds. If Bitcoin falls below 70,000, another wave of forced selling begins. If it falls below 65,000, an even larger wave. The structure of the market right now is a staircase of sell orders, each level waiting to be triggered. Now let us talk about who is holding Bitcoin and why that matters. In 2021, Bitcoin was primarily a retail asset. Individual investors, crypto enthusiasts, libertarians who believed in decentralization. But starting in 2023, the composition changed. Institutional money entered, hedge funds, asset managers, publicly traded companies buying Bitcoin for their balance sheets. The argument was diversification. The argument was inflation hedge. The argument was that Bitcoin was digital gold. But institutions do not think like retail investors. Retail investors can hold through drawdowns because they are using money they can afford to lose. Institutions are using other people's money, pension funds, endowments, client capital, and those clients have expectations. When an institution buys Bitcoin at $100,000 and it falls to $70,000, the clients start asking questions. Why are we in this asset? What is the risk management strategy? When do we exit? And institutional money managers facing these questions do what they always do. They de-risk, they reduce exposure, they sell, not because they lost faith in Bitcoin's long-term potential, but because the short-term performance is damaging their reputation and their client relationships. This is happening right now. We can see it in the ETF flows. The spot Bitcoin ETFs that launched in early 2024 with so much excitement are now seeing outflows. Not massive outflows yet, but consistent redemptions. Money is leaving. And when institutional money leaves, it does not come back quickly. Institutions move slowly. They have committees. They have approval processes. They have quarterly reviews. Once they exit a position, it takes months, sometimes years, for them to re-enter. This means the buyer base that drove Bitcoin from 40,000 to 126,000 is now stepping back. And without that buying pressure, the price has no support. Retail investors alone cannot hold up a $1.4 trillion market cap. They do not have enough capital. The only way Bitcoin stabilizes is if institutions return, and the only way institutions return is if they see a reason to believe the price will not continue falling. Right now, they do not see that reason. Let us connect this to what is happening in the broader market. Bitcoin did not crash in isolation. It crashed at the same time as gold, at the same time as silver, at the same time as software stocks. These are not connected assets. They do not move together under normal conditions, but they moved together this weekend. Why? Because they share one thing in common. They are all speculative positions that became overcrowded. Gold had been in a ferocious rally for months. Silver followed. Analysts talked about the return of precious metals, safe haven demand, inflation hedges, the same narratives that drive Bitcoin. Then on Friday, gold collapsed. Analysts described it as a painful drop, a manic unwind. What happened was simple. Too many people owned gold. The position became crowded, and when one large holder decided to sell, it triggered a cascade. Others saw the price falling and rushed to exit. The crowded trade unwound violently. Bitcoin is experiencing the same dynamic. The difference is that Bitcoin is smaller and more volatile. So when the unwind happens, it happens faster and harder. Then there is the software stock collapse. Over the past week, software companies have been in freefall. ServiceNow, Salesforce, HubSpot, Adobe, all hitting 52-week lows. The iShares software ETF is down 20% year to date. Why does this matter for Bitcoin? Because the same people who buy software stocks are the people who buy Bitcoin. Tech investors, growth investors, people who believe in the future dominance of technology. When they see their software holdings collapsing, they look at their portfolios and ask what else is at risk. And they see Bitcoin, another speculative tech-adjacent asset, and they sell, not because Bitcoin fundamentals changed, but because their overall risk tolerance changed. This is called correlation in crisis. Assets that normally do not move together suddenly move in the same direction because they are all being sold by the same type of investor. And right now that investor is in full retreat. They are moving from growth to value, from speculation to safety, from Bitcoin to cash. There is another factor that most retail Bitcoin holders are not considering: regulatory pressure. In the United States, the new administration has sent mixed signals. On one hand, Trump is seen as pro-crypto. On the other hand, his nomination of Kevin Warsh as Federal Reserve Chair created uncertainty about monetary policy. Warsh is known as a hawk, someone who prioritizes fighting inflation over supporting asset prices. If the Fed under Warsh raises rates or keeps them elevated, risk assets like Bitcoin suffer. Higher rates mean higher opportunity cost. Why hold Bitcoin, which pays no yield, when you can hold treasury bonds that pay 5% with no volatility? This is the math that institutions run, and right now the math does not favor Bitcoin. In Europe, regulators are tightening rules around crypto custody and reporting. In Asia, China remains hostile. Japan is cautious. Only a few smaller nations are actively friendly. The regulatory environment is not collapsing, but it is not improving either. And for institutional adoption to continue, regulations need to be clear and favorable. Right now, they are unclear and tightening. This creates a headwind that prevents new money from entering. Now let us talk about the technical picture. Because in markets, technicals matter. Not because lines on a chart have magical predictive power, but because they reveal where large orders are placed, where support and resistance exist. Bitcoin breaking below 75,000 was significant. That level had held multiple times over the past year. It was a psychological floor, a line in the sand. When Bitcoin broke through it over the weekend, it triggered stop-loss orders. These are automated sell orders that traders place to limit their losses. If Bitcoin falls to 74,000, sell automatically. Thousands of these orders were triggered, and when they executed, they pushed the price even lower. Now the next level of support is around 68,000. That is where Bitcoin traded in late 2024 before the election rally began. If that level breaks, the next stop is 60,000. And below 60,000, there is very little support until you reach the low 50s. This does not mean Bitcoin will definitely fall to 50,000. It means that the path of least resistance is down. There are more sell orders waiting below than buy orders waiting above. The market structure is inverted. Let us examine the mining sector, because miners are the supply side of Bitcoin. They produce new coins every day. And they have costs: electricity, hardware, labor. When the Bitcoin price is high, miners are profitable. They can hold the coins they mine and wait for even higher prices. But when the price falls, miners face a decision. Do we hold and hope the price recovers, or do we sell to cover our operating costs? Most miners choose to sell. They have bills to pay, they have investors to answer to. They cannot afford to hold through extended drawdowns. This creates a steady stream of selling pressure. Every day, approximately 900 new Bitcoin are mined. If miners are selling most of that supply, it adds up. Over a month, that is 27,000 Bitcoin hitting the market. At current prices, that is nearly $2 billion of selling pressure per month. For the price to stay stable, there needs to be $2 billion of new buying every month just to absorb miner supply. But new buying has slowed. ETF inflows have turned to outflows. Retail interest has cooled. The math does not work. The selling pressure exceeds the buying pressure, and when that happens, the price falls. There is also the issue of correlation with traditional markets. For years, Bitcoin advocates argued that Bitcoin was uncorrelated with stocks, that it was a separate asset class, a hedge against the traditional financial system. But data from the past 2 years shows that Bitcoin now moves almost perfectly in sync with the Nasdaq. When tech stocks go up, Bitcoin goes up. When tech stocks fall, Bitcoin falls. The correlation coefficient is above 0.8. That is very high. It means Bitcoin is not acting as a hedge. It is acting as a leveraged bet on the same risk-on sentiment that drives tech stocks. And right now, tech stocks are under pressure. The Nasdaq has been volatile. Software stocks are collapsing. AI stocks are being repriced. If the Nasdaq enters a bear market, Bitcoin will follow. And there are signs that a Nasdaq correction is already underway. The rotation out of growth into value. The sell-off in high multiple software names. The concerns about AI spending returning insufficient profits. These are all warning signs. And Bitcoin, being more volatile than the Nasdaq, will amplify whatever move the Nasdaq makes. If the Nasdaq falls 10%, Bitcoin could fall 20 or 30. Let us talk about the elephant in the room, Tether. Tether is the largest stablecoin in the crypto ecosystem. It is supposed to be backed 1-to-1 by US dollars. For every Tether token in circulation, there should be $1 in a bank account somewhere. Tether is used to facilitate most Bitcoin trading. Traders use it to move between exchanges, to enter and exit positions, to avoid converting back to fiat currency. The problem is that Tether has never been fully audited. There are persistent questions about whether the backing is real, whether the dollars actually exist. If Tether were to collapse, if confidence were lost, the entire crypto market would cease. Because Tether is the liquidity layer, it is the oil in the machine. Without it, trading would grind to a halt. Now Tether has survived scrutiny before. It has weathered rumors and regulatory threats. But the risk is always there. And in a market that is already stressed, already experiencing liquidation cascades, a Tether crisis would be catastrophic. Bitcoin would not fall 20%, it would fall 50 or 60, because the infrastructure that allows people to exit would be broken. This is a tail risk, low probability but extremely high impact, and in fragile markets, tail risks have a way of materializing. Now let us shift to game theory. Who benefits from Bitcoin falling? There are players in this market who profit from declines, short sellers. Institutions who have sold Bitcoin futures contracts betting the price will drop. These players have an incentive to push the price lower. They can do this by spreading fear, by releasing negative research reports, by timing their selling to maximize impact. This is not conspiracy, this is how markets work. When a market is fragile, smart money identifies the weak points and applies pressure. And right now, Bitcoin is fragile, over-leveraged, overcrowded, supported by narratives that are breaking down. A coordinated effort by large holders to push the price below key support levels could trigger a cascade that benefits those holding short positions. We saw this in March 2020 when Bitcoin fell from 9,000 to 3,000 in a matter of days. That was not organic selling. That was a coordinated flush. Whales dumping supply onto the market to trigger margin calls, then buying back at lower prices. The same pattern could be playing out now. Let us also consider the macroeconomic backdrop. The global economy is slowing. Growth forecasts for 2026 have been revised down. The World Bank expects global GDP growth of only 2.6%. That is the weakest decade since the 1960s. In a slowing economy, speculative assets underperform. Investors move to safety. They prioritize capital preservation over capital appreciation. Bitcoin is the opposite of safe. It is volatile. It is unregulated. It has no cash flows, no dividends, no intrinsic value in the traditional sense. Its value depends entirely on the belief that someone else will pay more for it in the future. When economic uncertainty rises, that belief weakens. People stop asking what Bitcoin could be worth. They start asking what it is worth right now. And right now, with no yield, no cash flow, and falling price momentum, the answer is not encouraging. Add to this the fact that central banks are keeping interest rates elevated. The Federal Reserve is in no rush to cut rates. Inflation is still above target. The labor market is still relatively strong. This means safe assets like treasury bonds continue to offer attractive yields. Why take the risk of Bitcoin when you can earn 5% risk-free? The opportunity cost is too high. Another structural issue is the decline in new adoption. Bitcoin adoption follows an S-curve. Early adopters came first, then the early majority, then the late majority. By the time an asset reaches mainstream awareness, most of the adoption curve is complete. Bitcoin is now a household name. Everyone has heard of it. Most people who wanted to buy it have already bought it. The pool of potential new buyers is shrinking. And without new buyers, the only source of demand is existing holders adding to their positions, but existing holders are not adding, they are reducing. ETF outflows confirm this. Miner selling confirms this. The market is no longer in an accumulation phase, it is in a distribution phase. Existing holders are selling to whoever is willing to buy, and fewer people are willing. This is a classic late-stage bull market dynamic. The smart money is exiting, the retail money is holding. And eventually the retail money realizes there is no one left to sell to except at much lower prices. Let us examine historical precedent. Bitcoin has crashed before. In 2017 it went from 20,000 to 3,000, an 85% decline. In 2021 it went from 69,000 to 16,000, a 77% decline. Both times the pattern was the same. A parabolic rally driven by narrative and speculation, a peak. Then a slow grind lower punctuated by sharp drops. The current decline from 126,000 to 73,000 is a 42% drop. History suggests it could go much further. If Bitcoin follows the 2021 pattern, it could fall to around 35 or 40,000. If it follows the 2017 pattern, it could fall below 20,000. These are not predictions. These are possibilities based on past behavior. And the key insight is this: every Bitcoin crash has been deeper and lasted longer than retail investors expected. People who bought at the peak in 2017 waited 3 years to get back to break even. People who bought at the peak in 2021 waited 2 years. If you bought Bitcoin at 126,000 in October, how long are you willing to wait? And what if it takes 5 years? What if it never comes back? There is also the question of what Bitcoin actually is. For years it has been marketed as digital gold, a store of value, a hedge against inflation. But during the recent inflation surge, Bitcoin did not act like gold. It crashed along with tech stocks. Gold went up, Bitcoin went down. This broke the narrative. If Bitcoin is not a hedge against inflation, what is it? The answer that is emerging is that Bitcoin is a risk asset, a speculative technology play. It behaves like a high beta Nasdaq stock. This is not necessarily bad, but it is different from what was promised. And if Bitcoin is just another risk asset, then it should be valued like one. And risk assets are expensive right now. Valuations across equities are stretched. A correction is overdue. If that correction happens, Bitcoin does not escape. It leads the decline. Now, what should a rational person do? If you are holding Bitcoin, you face a decision. Hold and hope for a recovery, or exit and preserve capital. There is no right answer that applies to everyone. It depends on your time horizon, your risk tolerance, your other assets. But there are some principles that apply regardless. First, do not let emotion drive the decision. Do not hold Bitcoin because you are attached to the idea of it. Do not sell Bitcoin because you are panicking. Make the decision based on the data. The data says Bitcoin is in a downtrend. The data says leverage is unwinding. The data says institutional money is leaving. The data says there is no fundamental reason for the price to reverse immediately. Based on that data, the rational action is to reduce exposure, not necessarily to zero, but to a level where if Bitcoin falls another 50%, it does not destroy your financial position. Second, understand that catching a falling knife is dangerous. Many traders try to buy the dip. They see Bitcoin at 73,000 and think it is a bargain compared to 126,000. But price is relative. 73,000 is only cheap if it does not go to 50,000. And right now there is no evidence that 73 is the floor. Wait for confirmation. Wait for the selling pressure to exhaust. Wait for a base to form. Wait for some signal that the downtrend is over. Buying into a liquidation cascade is how retail investors lose money. The professionals wait. They let the amateurs get shaken out. Then they step in at much lower prices. Third, diversification is not just holding different cryptocurrencies. Bitcoin and Ethereum falling together is not diversification. True diversification means holding assets that do not move in sync. Bonds, commodities, cash, real estate. If your entire portfolio is crypto, you have no protection when the entire sector falls. And right now, the entire sector is falling. Every major cryptocurrency is down. Altcoins are down worse than Bitcoin. This is a systemic decline. The only diversification that helps is being outside the system entirely. Finally, be honest about why you own Bitcoin. If you own it because you believe in decentralization and are willing to hold through any price, then the current drop does not matter. You are not investing, you are participating in a movement. But if you own it to make money, to build wealth, to secure your financial future, then you need to treat it like any other investment, and that means cutting losses when the thesis breaks. The thesis for Bitcoin at 126,000 was that institutions were buying and the price would continue rising. That thesis is broken. Institutions are selling. The price is falling. Holding onto a broken thesis is not conviction, it is stubbornness. The market does not care about your entry price. It does not care that you bought at 80,000 or 100,000. It only cares about supply and demand right now, and right now supply exceeds demand. The weekend crash was not the end, it was a warning. A signal that the structure is breaking. The liquidation cascades will continue. The forced selling will continue. The institutional exit will continue until the price reaches a level where new buyers appear, where value investors see opportunity, where the risk-reward shifts. That level is not 73,000, it is much lower. How much lower is unknowable, but the direction is clear. Bitcoin is going down. The only question is how far and how fast, and whether you will still be holding when it reaches the bottom, or whether you will have exited with enough capital to buy back in at a price that actually makes sense. That is the choice, and the clock is running.